going on, everyone? Happy Wednesday. I hope you're all well and doing great. Ready for this session today on Fed Day. CTM, good morning, good afternoon, good evening, wherever you are in the world right now. I'm so glad that you're here and we are here together. And I'm looking to put together a beautiful work session each and every day, putting the work in, Fabio making sure that we stay on the right side across all markets. Today's a big day. Obviously, you all know we've been watching and waiting, having our eyes on this day for quite a while because it is a few that dictate the policy, not only domestically for the United States, but being the world reserve currency for the world at large. China, the other day, through their media outlets, voicing opposition to the fact that the dollar becomes the world's problem. They are promoting, obviously, de-dollarization. They would like a chance at the yuan playing a bigger role. And playing a bigger role it is, but a question of how long it takes for it to play even a larger role. Well, that's an entirely another story. It seems that maybe and perhaps the powers that be inside the U.S. are actually forcing de-dollarization. The policies and the decisions that they have made, including confiscating the central banks of Russia's dollar reserves, also the euro reserves, I say confiscated, quote unquote frozen. It's not the first time either. Going back to World War II, that was done to Germany by the US. We are seeing lots of things repeat themselves once again. Nevertheless, it does seem like the US is trying to promote people not actually using the dollar. And then you have the rest of the world that is forced to. Again, everyone is indebted in dollars. You have to pay it back with interest. Here lies what becomes the dollar shortage problems. We're looking today at the Fed, 82% chance the market is pricing in they're going to raise rates 75 basis points. There are a couple of people out there who do believe that we're looking at a shock and awe 100 basis point rate hike. We will soon see. It is worthy. You're seeing 150 basis points today, huh? I don't know. I guess anything's possible, but is that because like people are looking for some type of interaction? I don't know. That doesn't seem right. But we'll see. I mean, I've been wrong before. We're looking here at, and I just want to pull up the mouse over there as we get going. What's notable about this chart here of the index of the NASDAQ is that this rally over here from March into the end of March, that was after the FOMC, right? And then we're looking down over here, and then we had another rally, and this was the rally that extended throughout July into mid-August. No, that looks like the beginning of August. That was Jackson Hole that put a quick and rightful end to that. But this one started off the 9.1 hot CPI print, extended by the 8.5% CPI print, and then also the FOMC, the last month's FOMC, when Jerome Powell kind of let it slip that we are close to achieving neutral rate. You saw the markets really rally, and then it was after that crowd control, or I should say market control, happened with all that verbal intervention and the Fed talking it back because, again, all of the tightening had been done. I feel a lot better with the markets kind of right off the June lows than if we were rallying into the Fed's meeting. That would be a cause for concern because it means that the Fed doesn't have to come out overly hawkish. Right now, they have the market really where they want it. They're in control. We will see. Lots of people, if you zoom out, are really looking for this type of behavior to happen. You could see over here, like holding in by a thread and a waterfall down. That seems to be what really everyone is prepared for. Now, the question is, who's left to sell? We know the professionals are really hedged to the options market. They're holding on to their stocks. They don't want to sell their stocks because eventually, as you all know, the market is already pricing in rate cuts coming into 2023. The more they raise rates, the more the rate cuts get priced in forward. And what that means is that we're looking not only as rates being cut, the quicker rates are cut to zero, then the next batch of monetary expansion will occur, balance sheet expansion. And that's why people are not really in a rush to go ahead, sell their stocks, pay capital gains tax on that, and that long-term beat or whatever. And, we'll see how much selling is left here. Yeah. No, not. Yeah, a lot of people. I remember Jeff, right? Dollar Villajanti. Jeff that puts out some great work. Fellow Mexican, Canadian and Mexican. And he was always. So sometimes those things have worked out, and there's been many years that they haven't. I don't know. It seems like the perfect storm is definitely aligned. If you saw overnight, we saw the dollar rising to new yearly highs. It's at 110.70 as we speak. That is nosebleed heights, and it could go much higher, especially today as the Fed comes in, gets ready to tighten even further. We are seeing, though, by the way, the dollar rising once Vladimir Putin, that's what we should call him. How do you think he would like that? Hey, Putin. He said that he's mobilizing the reserves in Russia, calling up 300 people who do have some type of military experience, mostly those in the armed forces, I want to say. Air Force. Maybe not. Don't quote me on that. But the reaction from China was quite interesting. Let's take a look. I'll read. It's very crafted very carefully not to upset Russia and at the same time to make known what they would like to see happen. Every country's reasonable security concerns should be valid, and all efforts conducive to resolving the crisis peacefully should be supported. China calls for dialogue and consultation to resolve the divergences. So China seems to be a little bit pulling away from Russia, very careful to support them, but at the same time, they are calling for dialogue and for this current crisis to be resolved. China is under a world of hurt right now. By the way, also here, before we get into some macro stuff this morning, as it is Fed Day, wanted to point out the 10-year, right? This is what we were looking for yesterday. We were looking to see as we gapped up into nosebleed heights, whether or not we would have a gap down the following day. We do. Now that gap has already been closed this morning. You can see when I say the gap has been closed is that price. Here's the gap up, right? Price came down the wick. It never closed the gap over here on the downside. Now this next day though, I was looking for an island reversal, and an island reversal is basically one candle, right? A next candle with a gap up, and then a candle with a gap down. It is a reversal pattern, and I know people right now, or many people, don't want to look at any type of reversals in such a strong trend, but I think that for me, when you look at what happened in April and May 2021 across the cryptocurrency markets, right before we had that crash all the way down into the summer of 2021, that it would have done everyone a lot better, regardless of the current momentum, to be looking for some type of mean reversion. And I think that holds right now. What's the title of this video, by the way? The title of the video, I don't have it in front of me. It's something about a policy mistake by the Fed. And, the Fed is going to make a policy mistake unless this time is different. And by the way, it's always up for debate whether or not the Fed ever makes a policy mistake, or that's exactly, they're actually very calculated and are able to actually execute according to their intentions. Again, their incentives are not the same as ours. And from our perspective, it looks like they continually drop the ball. I think that they're doing a good job of doing exactly what they set out to do. And including, by the way, have you ever thought when they were telling us that inflation was transitory, that really they wanted the economy to continue to run hot and inflation to really gather some steam? Maybe they wanted the ability to go in there and come out overly hawkish to crash the market. Maybe they wanted to go ahead and orchestrate some type of crisis. Maybe they wanted to orchestrate some type of crisis so that they could go ahead and come to the rescue as they get ready to implement Fed Now next year in 2023. I don't think that the general population, I spoke to regular normal people and I asked them what they thought about central bank digital currency. No one is happy about it. No one wants to willingly accept that. Now, of course, you have many fans of the government, fans of government control, and they'll be embracing it. But regular people, like normal people that your kids go to school with, like they're talking about if that happens, they would be revolting in the streets. So again, in order for them to be able to go ahead and introduce something like that, maybe they do need a crisis. Anyway, just some thoughts. People talk about that markets have never been able to, why the Fed is hiking, put in a bottom and rally. That's not true. The last hiking cycle ended December 2018 on a rate hike. It was a rate hike, a 50 basis point rate hike. That same day, Paul Tudor Jones, legend, got on CNBC and he said that was a policy mistake. That will be the last hike of the cycle. And from that day on, the markets rallied. A few weeks later, the Fed actually verbal capitulated and said that they are going to be returning towards easing. Is that happening today? Not likely. I don't think that's happening today. I don't think this is going to be the last hike of the cycle. It's looking like right now November is pricing in a 50 basis point hike. The market, by the way, ever since the last CPI, the CPI this month, remember the market's data dependent right now. They were pricing in November a 25 basis point rate hike. On that hot CPI, the market is now pricing in a 50 basis point hike. And guess what? We have a couple of more data points until we get to that November meeting. And when I say couple, I'm talking about CPI alone. We have many more data points. The market's data dependent. And even though we're looking for some clarity today, at the end of the day, we're still going to be left very fuzzy. It was Stanley Druckenmiller who said in that video we looked at yesterday that this is the first time in his career in over 40 years where the macro has never looked so uncertain. And I think that is the best posture to take right now in these unprecedented, uncertain times, not to pretend for any moment and get comfortable that you know what's going on, but continue each and every day to be learning the lessons of what the market is teaching and do your best to stay on the right side. That's where we are. So we saw and are watching this potential reversal. So I feel like you ever find yourself self-censorship? Like, did you ever want to post? I noticed it happening to me all the way. You never noticed yourself self-censored? I have. I remember it all the way back in it must have been like 2009, 2010 on the Facebook. And then I would be like careful about what I posted out there because I didn't want to upset people. And it happens today across social platforms. Now that was a while ago. Today it's much more prevalent. And I think that's engineered. I think that is done on purpose. I know people don't like to think that they are purposely engineered by the powers that be, but I bought toilet paper back in February of 2020. We were here on CTM lining up what was happening across the world. We were very early. It was since the last week of January. We positioned early. We absolutely crushed it. There were few people at that particular moment who crushed it ahead of time on the way down and then on the way up and all the way. If you forget, most on both sides, most macro experts got it wrong. And I think that's one mistake that many people make. Many people see the general narrative out there across, let's call it Twitter or whatever have you. And people come out there and people are analyzing or giving their view of what's happening now. They're not forward thinking. They're taking it in. Not all of them. Some people are very forward thinking. They're the ones that take the greatest risks. By the way, people like Raoul Pal is very forward looking. He puts out what his expectations are ahead of time. And that's why he also gets a lot of flack when he's wrong. Of course, he's going to be wrong many times. That's most successful traders and investors are. Luke Gromen puts it out there ahead of time, what he believes is going to happen. There are analysts who are very forward thinking, provide massive signal, but there are also those who are very good at recapping what's happening now, right? And they're very loud about what is happening. The Fed's tightening. You got to be in dollars. But they caught up like 6 months too late. And then, anyway, self-censored. That's what I wanted to talk about. Thank you, Luke, for bringing me back to where I was going. I feel self-centered. I know I self-centered myself. I try to be aware of myself. If you want to be very successful in the markets, your greatest obstacle is yourself. And the more you work on understanding and knowing thyself, the better that you're going to be in the markets. And one thing I notice is that right now there's almost a bit of censorship out there in the markets about those who talk about potential reversals. For example, on the DXY, right? Right now, the DXY here above 110 coming in strong, and it is so strong. There's no question about it. However, if at any time we get some type of breakdown, look, I'm gonna point it out in real time. Some people out there, the response whenever that, like over here when this was a double black diamond, the second attempt at it, and people were almost indignant that you would talk about any type of mean reversion taking place because they're talking about straight up to 120 with nothing in between. Well, we went from 109 back to 105. That's not really straight up. Same thing happening here on yields. Like, guess what? Right now, the yields are screaming. And as the Fed comes into hike today, there's no question they could end the day at a new yearly high. There's no question about that. But it doesn't mean that's what's going to happen. We could see over here, just following this line over here, once that line breaks, regardless if you like it or not, a sell impulse is in play. And by the way, not only is it a sell impulse, and that doesn't mean if it triggers that, number one, we're coming down into this line of resistance right around 2.6, a little bit higher right now, or that we break it and go even lower. It just means that the current momentum is breaking down. This is a massive move that has taken place over the last 6 weeks. Things don't go straight up, don't go straight down. And usually when they start blasting off at that point in time, they're getting a little sketchy. Be very careful. I guess what I'm trying to say is I'm gonna be here to call it as I see it, regardless of what other people want to hear. And that's all I have to say. John, what's going on? Good morning. Great morning, everyone. Troy, glad to see you over here today. No, I didn't see that. Is it still up over here? Let me pull it up. I want to take a look. And I'm just going to pull down 1 second. I don't know. They're shoulder to shoulder. They're shoulder. Oh, yeah, he's in the back. Oh, yeah. Yeah, so that's funny. I mean, we don't realize it. These things are really chosen very thoughtfully. Craig, nice to pick up on that. That's why I'll leave it at there. Next move is down big, and we'll proceed the introduction. Ready, steady. What's going on, brother? It's been a minute. So it's ready, steady. You were here back in April 2020. Do you remember April 2020 and people were looking for the insolvency event for the markets to crash and take out the lows because of blah, 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 blah? And do you remember I said, no, that not likely, that the markets did crash and the Fed's policy response was probably not only appropriate, but overdone. And I talked about when the next time I thought there might be a crash. And I said it was 2023 because it looked like that's when the Fed potentially would be able to introduce the central bank digital currencies. We're getting there. Ready? I don't know that the next big move is down. What do I mean by that? I mean, right now people are prepared. They're braced for impact, and rightfully so. But I think everyone is positioned. I guess what's left down on here on crypto would be if price breaks down towards 14, 15K, you would probably see a lot more forced liquidations. And that could have an effect where you start seeing price continue to cascade down, but it would come to wherever the forced liquidation stop, price would, like a beach ball held underwater, probably spring back up from where it was, right? And then what happens next? I mean, whatever. I'm not looking that far in advance, but in the equity markets, I mean, a lot of people looking for the structural June lows to be taken out, over the next week by the end of the month, maybe even to October. That seems to be what we're all prepared for, right? But I don't know that, like, I think that I really genuinely believe that they are looking to extend the cycle out as long as possible. I don't think that they're ready to introduce central bank digital currencies at this point in time. And really, I believe if that's going to happen, and if things are going to get so bad that they're going to go ahead and be able to crash this thing down, you're looking out much further. When people talk about the Fed is going to tighten until things break, right? Don't forget, going back to April over here, like many people thought by then that things would have already broken. When we got to June, people were surprised that things hadn't broken yet, right? That was like the general theme out there across podcasts, across macro analysts and whatnot. And the whole time I'm sitting here saying, well, it's probably going to take a lot longer than people imagine for things to break. If you go back towards last cycle, you remember that, things didn't break until after QT was running for quite a long time. The markets had rallied back to new all times while QT was underway. And when things broke in September 2019, and no one expected it was going to be in the repo market, that, like, Fed balance sheet expansion started, and markets were trading right off their all-time highs. Equity markets were, at least. This is over here. Let me just show you on a chart. I'd like to look at charts as we're talking. And this is September 2019, right? So September 2019, repo markets break, and markets are just like a stone throw off of all-time highs. And then they're able to go ahead as balance sheet expansion starts. Markets begin melting up until the global lockdowns. And also remember, when things broke again, things broke here in September. Things broke really bad during the dollar liquidity shortage as the global lockdowns took place. Unprecedented times. Were just 2.5 years ago as well. And of course, we continue to be in the aftermath of that policy response. And of course, we continue to be in the aftermath of the policy response since, 2008. And it just all is cumulative and continues. But we didn't take out a lower low than happened in December 2018, right? Do you remember this over here when all of a sudden Treasury Secretary Mnuchin calls up his friendly CEOs at the big banks? President Trump gets out on the Twitter and he's like, now would be a good time to buy stocks. And then sure enough, Fed hikes rates and then market rallies, puts in the low. During the crisis, we didn't take out that low. And that's something that could happen going forward if, when we get to the point in time, I mean, the Fed is not going to raise rates forever. The debt is a real thing, and they are limited about how far they could raise rates because of the debt. Like, there comes a point in time as you raise rates where the debt becomes inserviceable. So that it's not like they could just, because inflation is running hot, and even though they're raising rates, and even though that really doesn't really affect things so much, they are limited. And if by the way, markets at any point between now and 2023 are able to put in any type of rally, when we do eventually move towards a pause, when things actually break, it doesn't mean that wherever the low is, whether it's here in June or whether it's in November or wherever the low comes in, it doesn't mean that when the crisis happens that we take out that low. Here's a perfect example of that not happening, right? So a lot of people are expecting crisis 2023 and then the whatever the structural low is taken out. That could happen also. I mean, look, to be honest, and I love having the posture, I rather not have a bias. I rather trade what's happening. It serves me very well. All right, let's keep going over here. I want to talk a little bit about this morning about Caleb's tweet from yesterday in honor of it being Fed Day. So we're going to get into that. It's a long thread. It is really good. So, and this is also, by the way, except for skimming it this morning before going live for literally 20 seconds. I wanted to read it live to be able to go ahead and have my like initial interpretation and be able to share it with you like that. Yeah, the most popular fractal in the world, and today it could be proven true. If we today, if the markets sell off, and the markets this morning are kind of like, well, they're barely in the green. It looks like crypto got a hold of potentially a little bit of hopium this morning. And who there thinks, by the way, short that odd one, man. That's great. That's a big move over there. 52%. If you get it, that's good. 20 shorten at 20K. I mean, to 9K. How does that work? Could you give a little bit more thought into what actually, or how actually that strategy is crafted, that you have a signal here at 20K to be going short on the Bitcoin and that you're targeting 9K? That would be interesting. Odd one. I've seen it happen so many times where people throw out random stuff and it becomes true. I've seen it happen before, and then they'll jump back on the live stream. They'll be like, "You remember when I told you that?" In this case, I would, Ottawa. Most times I don't remember. People are always having all sorts of ideas. Ace, great morning for you, for sure. We are holding short coming into the main event. We were also into Jackson Hole. In Jackson Hole, we were holding short positions, and after Powell got to release his 8-minute speech, that was changed at the last minute because of the market rallying up into Jackson Hole. Those positions extended into profit. I don't have those expectations now, Ace, even though I'm positioned at the same price as you, right? 20K, 20,174. My expectation is this does not bleed into 9K. My expectation is that later today, tomorrow, that I have to exit this trade, and even though it's 6% into profit, that maybe even it's at a loss. I mean, I just, rather than having any type of expectations what is happening, I prefer to trade what is happening, and it serves us pretty well. This is 2021. I get it. It's only 34%, 24% drawdown on the Bitcoin, but it's not the easiest market to be trading right now, that's for sure. Ethereum is providing a lot more alpha. Anyone who tells you, by the way, that Bitcoin is better to trade than Ethereum, right then and there, they do not know what's up. Massive more alpha to be had on Ethereum with less risk, 20% drawdown, 189%. I mean, that's just into 2022. Go back a year into 2021 on Ethereum, absolutely crushing it. Same drawdown, less than 20%, and absolutely crushing it. And Bitcoin, by the way, there's less alpha there, but anyone who's telling you in the last 18 months that they're not happy with 125% return, I mean, do you got to really take that seriously? This is for sure a trader's market, but a tough market. Give us a little bit more time, 2.5 years, and then Bitcoin's doing its thing. It's a beautiful return for just 2.5 years, and then Ethereum is absolutely spectacular. Again, still under 20% drawdown, and odd one. That's how we do it. We don't really have any idea whether or not Bitcoin's going to be trading at 9K or 3K, or if it's going to be trading above 69K, and it really doesn't matter. You can't get tied into just having an idea about what you think is going to happen, especially in this current macro climate. We had someone yesterday join us, 21 years old, joining CTM on team. And it was almost unbelievable to me. And he basically is like, yeah, I thought I'd learn a thing or two off of your experience, And, the one question that comes to mind is, could someone that young, well, first thing that comes to mind is how amazing that people that young are so intensely involved into investing and the markets. How amazing the opportunity to have stumbled into working with CTM. And then the third thing that comes to mind is, how are they going to be able to value what they've stumbled into when they don't know any better? How do you have nothing else to really compare it to? How do you know the value of time, and that if you stick to a plan for the next 10 years, you're probably going to be able to have the opportunity to make more money, not than anyone else in your class or anyone else that you went to school with, right? And then forget about the next 20 years after that. I remember buying the Google IPO. I remember buying the Facebook IPO. I remember selling both within several months for triple digit gains, thinking I was a hero and I knew what was up. If someone had kind of mentored me and told me, right? And by the way, my uncle, he had two newspaper routes. He retired very young, a multimillionaire, and all as he ever did, I mean, he's kind of from the Warren Buffett age. So all as he get to do was buy good companies and hold them. And when they came off, he would buy more of them. I remember in 2008, 2007, 2008, when Ford got crushed, right before Uncle Warren got basically a free pass on a $5 billion investment by the US government to bail them out, he went ahead and he bought it. He's like, Ford's been here forever. It's going to continue to be here. Right. And that was the climate they lived in, where it was this really easy money, uber deflationary environment, low yields, and it was just buy and hold. But he could have sat down with me once and ingrained into me that long-term mindset, right? A lot of people today were very, very, very short-term minded. And anyway, just wanted to make sure that everyone understands. Bay, working with CTM since 2020, I learned so much about the markets at macro. I'm graduating. This blows my mind, Bay. And more young people should be aware of the markets. That's beautiful. That makes me really so. And that all comes from you. My nephew, right? It was 2 years ago. He entered university, and he was really into the stock market. I guess Robinhood generation and whatnot. And I tried to help him out and embrace him, but you can't really tell, especially a young person, like what to do. It has to come from them. And Bay, that comes all from you. You know, that's beautiful. All the credit 100% goes towards you. It's beautiful. So, yeah, Ace, I don't have it ready for today. And maybe I will by the time we go live at 12:30 Eastern time. But my intention, as I said yesterday, was for today or tomorrow to really dig into that option and take a strong and good look at it. The best way I could give you, the best thing I could look at right now would be if you go to the video released on Sunday on this channel. It is talking about Bitcoin will dominate Ethereum. And the analyst is coming from Benjamin, from Ben Cohen, and it's really good. That's where I would send you to be looking at. And he was talking about this distribution pattern. Again, a lot of people, as things are at their highs, they don't want to talk about it. He was talking about it when it was a little bit difficult before the meltdown over here. Well, yeah, he's back at almost entry. It's a great video. I really highly suggest you watch that. And the way that I'm going to be talking about it, or the way that I'm going to be tackling it, is CTM style. So it's, instead of just trying to guess where this is going, just make sure that everyone has the tools there to trade it. All right. So it's a little bit different, but if you're looking for more of like general opinion type analyst, watch that video. It's a great one. Wanted to talk about Caleb's video or thread over here. So everyone, as we get going, if you haven't yet and you enjoyed being here this morning, I enjoy being with you all. You don't have to smash the like button. I'll do it later. No, I really enjoy, as it's been what now? It's been almost a month we've been together doing these live streams, and I really value the time spent together. Thanks for being here, everyone, today. I wanted to, Ace, also, by the way, maybe start out today's session and kind of take a look at different instruments and things that everyone wanted to look at. But I've liked the flow, enjoyed the flow so far this morning. And more importantly, we are coming into the place where, boom, boom, it's Fed Day. So in honor of the Fed Day, let's take a look at Caleb's thread over here. I'm starting to grow. I'm starting to see a growing risk that the Fed over tightens, right? One policy mistake doesn't fix the prior one. The prior policy mistake that Caleb is pointing out was the Fed was too late in tightening, right? The Fed said that inflation's transitory and they were behind the curve. They should have been well ahead of it, unless, again, that wasn't their intention. I don't think for a second that all of us were able to discern that, you know what, first of all, not only is this massive balance sheet expansion going to be uber asset inflationary, but once the government started bypassing banks and giving free money out to businesses, money into people's bank accounts, like we all knew that this was going to be really, really inflationary. I don't think all of us got it right and they all got it wrong. I think they knew from the beginning what was happening. And if they didn't, why are they still there? Either which way, the policy mistake was letting everything run very hot without getting ahead and tightening. Why everything was still running strong. Again, usually when the Fed tightens, it's into a very strong economy, and the economy could withstand the tightening. Usually, around the time of tightening, risk then begins to rally and rallies to new all-time highs. It doesn't really start getting bad until that tightening has an effect on the economy, and it's a lagging effect. And you start seeing that tightening cause less and less investment. You start seeing companies lay off workers, and then once people are laid off, there's less spending all around, and then eventually the Fed starts cutting rates, and that's when things are starting to get bad. In this go around, the Fed began tightening, and we've seen already two quarters of negative GDP growth. We are on the verge of putting up a third quarter in a row as Atlanta's third quarter GDP expectations have gone down now yesterday to 0.3%. The Fed is walking a tightrope of short-term inflation dynamics versus long-run inflation expectations. They're essentially trying to time the market, and it's a risky business. Unfortunately, they don't have another option without further damaging their credibility and unhinging inflation expectations. Unhinging, and if that could get dangerous, right? Just pay attention to those words. I'm reading this for the first time, but I'm sure that's gonna be built upon. The Fed has managed to keep inflation expectations low. By the way, I saw a survey where people from both parties, people in the United States, like to associate themselves with a party. I like to associate myself as an American. And, one of those Americans that really value the pursuit of freedom, the pursuit of happiness, the pursuit of liberty. And they talked about what type of inflation they've seen. And it's interesting that those that associate themselves as Republicans, they have seen higher inflation than those that associate themselves as Democrats. And for example, those that associate themselves as Democrats say that when they go to the grocery store, they've seen about a 7% increase in prices. Those that are Republicans say they've seen about a 9% increase in prices. I know it's very close, but there is a difference. And it's funny because I see a drastically different price. Are you kidding me? Eggs are up 50%. What are they buying? I have no idea. Milk? I mean, I do the shopping in my household often, weekly, multiple times a week. We got 6 kids. These kids just keep eating. It's absolutely ridiculous. So I'm very aware of the prices, and the prices that we experience, the inflation that we experience is a lot higher than the official numbers, even if they're, just under double digits. That's for sure. The Fed has managed to keep inflation expectations low, right? They'd be in a much worse position if expectations become unanchored. There's this saying about inflation that the genie gets out of the bottle once people expect that in the future prices are going to be higher. Once people have it ingrained in their brain that going forward, prices of goods and services are going to be higher, that's when inflation becomes almost like a self-fulfilling prophecy. Now, whether that's true or not, that is definitely the general thought about it. Year-to-date lows for 5-year break-evens. This has been an extremely odd divergence with underlying inflation dynamics. Core, medium, trim mean rising while headline decelerates. In green over here, you have headline inflation. We saw last month, right? We had first 9.1%, then we had 8.5%, and then 8.3%. What was really different about the 8.3, although headline inflation came off, core, medium, trim, they were all rising, right? And basically the only reason headline came off was because you were looking at lower energy prices. We're seeing the Strategic Petroleum Reserve being drained. And of course, that is having an effect on the market. And we are seeing headline inflation come off because of it, but inflation continues to still rise. That's very worrisome, especially when we talk about we mentioned something longer term run inflation expectations. Long run inflation expectations. I myself was expecting around June for a peak in the wave, right? And then I was surprised when I saw this month, September, it wasn't curling over. The headline was the green one, but that's almost fake, right? What happens once the petroleum reserve is finished and depleted? They got to start refilling it. The supply and demand is going to be a lot less supply in the market and now more demand. And it's all fake because you're looking so far still at these continuing to rise. So I was wrong about the peak. I mean, I called it at the very top, but I was wrong about it. But I couldn't know I was wrong about it until September, right? So I don't have any problem being wrong at any time. I want to be on the right side. Hold on one second. Let me continue on. This has been an extremely, thank you, Caleb, by the way, for providing this for all of us. Really, really grateful for everything you put out there. If you're not yet following Caleb, at the end of this tweet, I'll make sure to include his link inside the chat so you can make sure that you are following him for sure. Good morning. Great to see you here. Great morning, Mountain Initiative, right? So let's keep going. That's all, right? So the only thing that's driving down headline inflation is the lower energy prices right now. This a massive risk to the Fed's success. This possesses a massive risk to the Fed's success in getting inflation down. And we all know, by the way, that there's really little that they can do to get inflation down. We were looking, we got 6 kids. It's hard to fit them in a car. We're looking at, getting some type of like Sprinter, expedition type vehicle. And first of all, in all of the United States, there's less than a handful. There's not even a handful available. There's like a really long wait time. And the ones that will be available over the next 2 months, they're just like, okay, well, here's the price. And by the way, if you want it, Ford's tacking on an extra $20K. Mercedes an extra $25K. Why? Well, because they're like, there's only a limited supply of them. There's the supply and demand. So that's a big problem. That's when inflation really happens, when people have money, but there's no products available. And the Fed can't control that. The Fed can't fix these supply chain dynamics. They have no control of that whatsoever. And all they really could do is basically not even only cause a recession, but a depression, right? Maybe that's their goal. I don't really know what their goal is. I don't think that their incentives are the same as ours, and the same with our politicians, right? Look, let's just call it as it is. If people are really actually looking at progressing humanity and humankind, I do believe that we have the talent, the resources, and the ability to actually thrive. Doesn't seem to be the way that we roll. If the shelter component lags the housing rental market by 12 months, So he's saying shelter is causing a lot of these high inflation. It's a lagging, usually when shelter comes off, there's 12 months. It's very likely shelter will continue to accelerate through the first quarter of 2023 or the next 6 months. We should be seeing a continued pressure on CPI because of shelter. It comprises roughly 33% of the CPI calculation and is accelerating at the fastest year-over-year pace since April 1986 at 6.3%. We'll see. I mean, I've seen a for sure change in the housing market. You're seeing much more inventory for sale. People who want, like, people feel like they missed the top and they're almost in a rush to get out the door. And buyers are like, are you kidding me? It's X amount more expensive for me to buy the same piece of property now. And I can't even afford that. And we'll see what happens. The Fed is tightening at an aggressive pace. If we measure the nominal year-over-year increase in the effective federal funds rate, it's risen by 2.24%. This is largely magnitude that the environment leading up to the housing market crisis and fastest pace since 1995. Excuse me one second. Fed is really tightening at an aggressive pace. The fastest pace since 1995. It's going straight up. You can see over here. Do you remember over here? By the way, this is fourth quarter 2021. The Fed, people say don't fight the Fed. Do not fight the Fed. The Fed said, you know what? October meeting minutes from the September meeting, we're going to be tapering down our assets purchase and getting ready for liftoff. Every single person out there fought the Fed. Now they tell you don't fight the Fed. Interesting, right? So what is the Fed doing now? Well, the Fed's tightening and people are like, don't fight the Fed. But what's the Fed doing next? What are they going to communicate today? More importantly, perhaps than today, as that's already priced in. Unless they surprise us, they could surprise us. 18 markets pricing in 18% chance the Fed will come out and raise by 100 basis point hike. Some people out there today on the comments here, I saw 150 basis points. Yeah, I guess why I would call it a 0% chance. I guess if someone is talking about it, there's, who knows. But more importantly is going to be next month in October when we get the meeting minutes from what happened yesterday behind closed doors, from what happened today behind closed doors. And then we get an idea of what they're really thinking and seeing. When hiking by this magnitude in 1995, and by the way, so people were indignant that the Fed can't tighten, and then you could see it, yeah, the Fed and central banks worldwide have gone straight up. When hiking by this magnitude in 1995, the dot-com bubble burst 5 years later. So even though in 1995, the Fed began hiking and hiking really strong, look, this is where they pause, right? And then they pause, they come back raising rates, back off again. It's always been my thought that the Fed wants to extend the cycle out as long as possible. They did a great job coming off of the 2008 crisis. They were able to extend this cycle here for 12 years. That was brilliant. That's what they want to do. They're just buying time. The financial system is inevitably going to collapse. It's unsustainable. So what they're trying to do is buy as much time as possible all the time. People talk about the Fed is tightening to things crash. They want to crash things really quick. Maybe they do. Maybe they want to cause a depression. Maybe they want you to beg for central bank digital currency and then they'll come to your rescue. Or maybe they're trying to actually keep this thing going, right, as far as they can. And that won't happen in 2023 or 2024. Or maybe we get, a Hail Mary over here and the Fed actually engineers, people aren't going to want to hear these words, a soft landing. And 2023, 2024, 2025, that would be max pain if equity markets kept rallying and going up. No one expects that. Who knows what's going to happen? Take that mindset. Anyway, Caleb's pointing out, this is the sharpest rate hikes coming into 1995 since we have today. And then we see, by the way, that 5 years between the height of the peak of the rate hikes and the dot-com bubble bust. This one's also pretty aggressive, right? That's pretty aggressive also. Um, when hiking by this magnitude in 2025, okay, he got it right there. Caleb's always on point. I really enjoy Caleb's analysis across markets, including his TA. It's a really good follow. If you're not yet following him, I really do recommend it. It is a lot of signal amongst noise out there. The difference between these prior environments and now is inflation. So the Fed is likely to pump the brakes harder, right? One difference between now and then is inflation. Okay. Now, one also thing, though, difference between what was going on then and now is debt. And debt is significantly higher now. So to the degree that they raised rates over here, to the degree that they raised rates over here, you remember the debt, government, Fed's balance sheet really started growing at this point in 2008. It's significantly higher. So even though they've raised rates almost on par as these particular times, from a debt to GDP ratio, it is significantly higher. So off of surface appearances, the amount of not only the rate of increase, but the degree has been phenomenal. They've already come pretty far. Jordan, envision a scenario where they start QE again and then the market doesn't buy it. Yeah, that's going to happen, whether it's the next. Yeah, I think that drive, I'm right with you, that we do see diminishing returns in this Ponzi scheme, this financial system that we have, as far as when we do have balance sheet expansion. If you remember in 2008, it was $850 billion, and that number was so huge. But then 12 years later, it took a $4.1 trillion expansion, right? 5 times as much. And then followed by, for the next 2 years, another 1.4 trillion each year. And then the next time they need to expand their balance sheet, it's not going to be by 4 trillion. It's going to have to be bigger. It's the only way to keep it going. I agree. Eventually, they're going to come a point in time where, and what happens if they don't, though? Like, Drive, I'm with you. I think that next time there's a crisis, they're going to come out. They're going to have to do a restart QE, or maybe they restart QE first. Like in 2019, they started QE, and then they were able to extend things out for another year. And then things broke with global lockdowns and balance sheet expansion. I don't know which one of those is going to happen, to be honest, or how it's going to look like. And that's the thing, is no one knows what it breaks is going to look like. No one knows ahead of time. Right now, you could look around and you could ask yourself, well, everyone's telling me the Fed is going to tighten until things break. Well, usually they stop tightening before things break, right? Does anyone here have an instance in the history, we'll say since 1913, when the current Federal Reserve or the money masters took power again, where the Fed has gone from a rate hike to balance sheet expansion? I do not know of one of them. So if anyone has an instance of that, that would be interesting for me to see and learn from. But that's not really, from my understanding, how it works, right? It's why when things get bad and they start cutting rates, is that like things are really getting to like when you got to be zoning in and looking for the jump point and looking for when they're going to be, is when they start really cutting rates rapidly to zero. The reason they're cutting rates rapidly to zero is because QE has much more of an effect once you are at zero, right? Ben Bernanke articulated that. I don't even remember what year. It was a while ago. Let's keep going. I do believe in diminishing returns as far as the Fed's ability to inflate the system. And then it also worries me, what happens if we all believe that if things break, they're going to inflate the system? What happens if they let it crash in a deflationary spiral? I mean, I can't believe we have to have these conversations today. Anyway, I look forward to better times. With today's rate hike likely coming in at 75 basis points, the year-over-year nominal increase will rise to roughly 3% in the effective federal funds rate. It almost certainly won't be the last rate hike. I believe that, and I like how this is worded. Most likely, we're seeing right now the market's price in 50 basis points in November. This probably won't be but you never know. So he said almost certainly, and that's true. Particularly with members talking about a terminal rate above 4%. I mean, members are always talking about, they rarely get it right anyway. The pressure in financial markets and asset prices caused by rates is a factor of two components: the rate itself, the amount of time interest remains high. So this would be really interesting. This is good. So the pressure in the financial markets and the asset prices caused by rates is a factor of two components: the rate itself, however high it gets, and then how long they keep it there. Look and see how long they keep it over here, right? That's gonna, the longer they're able to keep, and that's probably where they're going, right? But remember, the pause is the pivot. The Fed has made it clear that they intend to keep raising rates, but they've increased language around the time factor. Yeah, it's beautiful nuance and highlight over there. Markets are waking up to this reality and pricing it in, hence the sell-off in financial markets. There's been no reprieve. It's been a relentless train wreck all of 2022. Stocks, bonds, crypto, gold, bloodbath. The worst year ever for the 60-40 portfolio since 1937. Historic tightening equals historic pressure on asset prices. Monetary policy certainly has a ripple effect, one that takes time to fully impact the economy and financial system. The Fed's problem is they don't know how long this lag takes. No one does. Notice that pause for effect there. That's beautiful. In the words of Milton Friedman, the lag is described as long and variable. My analogy over the past few months has been the Fed is operating an enormous ship with an immense layer of fog on the horizon. They can only see 100 yards forward, but the boat isn't nimble. They're running the risk of crashing onto the shore, unable to move fast enough. That's where we are today. And by the way, I don't think they want that. That's my own personal opinion, that they're not in a hurry to break things. People say don't fight the Fed. Do you take the Fed at their word when they say that they believe that the markets could withstand the tightening? Or are you fighting the Fed and you don't believe them? When people say don't fight the Fed, did you believe Jerome Powell last month's FOMC when he said he believes that they're getting close to the neutral rate? I took him at his word. I really believe him. The problem was that the market began front-running him too quickly and went too far. That's where we are today, further highlighting the Fed's dilemma. Inflation is sticky. Oh, yes, it is. And underlying components are accelerating. That's new, and that's worrisome. This was really shown so far in the September CPI print. Tightening is happening at a historic rate. Tightening is happening at a historic rate. Assets are crashing. The impact of this tightening is unknown. The Fed isn't nimble enough. Good bullet points. History shows us that the Fed historically provides excessive liquidity and is then forced to overstep their tightening cycle. This process has occurred in the absence of inflation, very different from today's environment. We don't know when their error will occur or its severity, and this time it could be a sovereign. People, if you remember what happened in 2008, if you don't, there's a great documentary to watch today. It's called Inside Job. I think Matt Damon is narrating it, maybe. Inside Job. And everyone's familiar with The Big Short, but watch Inside Job, much better. And the thing is that as President George Bush Jr. put it during the crisis on TV, he was like, well, the financial system is really just a house of cards. And it really is. If you pull one card out, the whole thing could collapse. We saw all of the derivative risk from AIG. This was coming off of them, but selling people basically insurance against their positioning in the housing market. And if a sovereign went down, call it Japan, call it Europe, or who knows what it would be, the third-party risk would likely take down the whole system. No one knows what it's going to look like or how it will happen. Margin call is a great one also. Economists seem to agree that a recession will cure inflation, but I'm not so easily convinced. I love that because as I read this first part, it says economists seem to agree that a recession will cure inflation. If you heard my voice, I didn't really agree with that. And then Caleb says, but I'm not so easily convinced for two reasons. A recession could aggregate supply to fall along with demand, leaving P in place. I'm not sure what that is. Price. A recession could aggregate supply. So supply would be, let's say, hold on, I'm having trouble understanding this, obviously. Economists seem to agree. A recession could cause aggregate supply to fall, so less products available, along with demand also falling. I'm not sure what that means, y'all. If anyone can let me know. Sam, you mean, am I trying to predict the market of where I think's going to happen? I'm not. I have no idea. I don't need to guess. I'm already positioned, and we'll take it as it comes. 1970 showed us that a recession doesn't immediately stop inflation. I need help with this. If anyone could explain what that means to me, including you, Caleb, that would be very helpful. Here's more on point one. So this is what he's talking about. Okay, so Caleb's already answering back on real time. It's a basic chart showing most economists don't want to acknowledge if the Fed creates a deep recession such that big aggregate demand and supply decline. Here is demand declining, right? It's possible that the equilibrium price remains consistent. Okay. So he's saying price doesn't fall as supply falls and demand falls. That would equal inflation. A recession doesn't guarantee a decline in inflation. Thanks, my brother. Appreciate that. He means that both demand and supply fall and price remains the same. Thank you, my brother. Appreciate it very much. Great morning. Here's more on point two. Facts about inflation in the 1970s. Year over year, CPI inflation was rising into the recession. Year over year, CPI inflation rose during the recession. Year over year, CPI peaked near the end of the recession. After the recession, inflation was historically high. Inflation roared back to new highs. Demographics were also significantly different back then. We have a big demographic problem going forward, specifically worldwide, whether you're talking about Europe, whether you're talking about Russia, whether you're talking about China, whether you're talking about Japan, and these type of demographics are not favorable towards a deflationary type of environment. I've been meaning to get these ideas out, and this week feels like the perfect time in light of the Fed's FOMC meeting and rate decision. If you appreciated these insights, be sure to sign up for my free newsletter. Do both. Here is Caleb's tweet so that you could go ahead and sign up for the newsletter, as well also follow him on Twitter. And look, Caleb did not ask me to share this. I would never do that if anyone did or anything like that. But I enjoy Caleb's insight into the markets. I feel like it's a kindred spirit out there, whether or not it's through his macro analysis or through his TA. I really enjoy this type of camaraderie in the markets. And that's why I wanted to do that with you. Right, Jim? That is stagflation. And Dalio is right about that. Dalio is right about a new world order forming. I'm not sure about Dalio is right about the rise of China. It's not looking like it at all. And it looks like that he might have bet on the wrong horse. We'll figure that out. We'll get into much more, let's say, macro geopolitics going forward. That is today. I wish I could give you an idea of what I thought was going to happen today. So all I could say is that I know that I'm holding two positions well into profit. And to be honest, my expectations are that basically they're going to end up, closing into either small profit or at a loss. If they wound up waterfalling into profit, I'll be grateful for it. But I don't have expectations about what I think is going to happen. It seems to me that a lot of people are positioned through the options markets, that there's really not much more selling to be had. I'm talking about equity markets, and that largely the thing to focus in today is going to be on the dot plots and what the members' expectations going forwards are going to be. But maybe it's even more of a non-event today. We've seen a lot of volatility coming into the event. To be honest, this morning, looking at the green on the screen, I said to myself, by the end of the day, it's a coin flip whether or not we're seeing more green on the screen or we're seeing deep red. I can't answer that. There's no way I could answer that. And there you go. That right there is experience. And that's what we're here to learn from. I know a lot of people like to be told what is going to be happening one way or the other, but sincere analysis in these unprecedented data dependent times calls for that type of, let's say, view. Oh, he did. That's awesome to know. I'm not familiar, honestly, with Ray's work except from headlines. All right. Thank you, Wolf Skull. Thank you so much. Blessings to you and your family as well, and all families, right? Not just families. We're all family. I consider all of us here together to be family. May God bless you all. Everyone have a beautiful day. Thanks for spending the time here, putting the time in, and I'll see you all tomorrow. All right, everyone. God bless you.